Please welcome to the stage Patrick Rivenbark from Cloudcase.
Patrick Rivenbark from Cloudcase. I'm a long-time attendee of FinTech Generation. It's always good to be here, and thank you for having us. So today we're going to talk about banking and crypto, really building off of the last panel. And we have three amazing folks here to talk about that at different levels and really going into the use cases. So if you have questions during this about it, we'd love to do it. A little bit about Cloudcase before we bring up our panelists. We help make enterprise decisions faster, and we do that by digitizing your complex business processes in your way. And typically, we're orchestrating all that business activity with a core, but we can equally do that with a blockchain, which is something we're doing a lot with, and helping you have compliant business processes that fit traditional finance frameworks to do a lot of what we just heard a lot about. So with that, I'd love the panel to come up, introduce themselves, and we'll jump right in. And if something goes wrong during this, it's because you have two Patricks sitting beside each other. So Patrick, why don't you go ahead?
Hey everybody, my name is Patrick Zielbauer. I am head of biz dev at BlockFills. BlockFills is a financial services and tech firm geared towards crypto native brokerage companies, payments, a lot of trading, derivatives. We are, of the group that's on the stage here, we're a little bit more focused on the trading side. So everything I say will be sort of through that lens.
Yep.
Hey everyone, my name is Leo Liu. I'm the chief of staff for the crypto team at Cross River. Cross River, we are a fintech infrastructure bank focused on banking as a service and now trying to bring crypto to fintech.
Sahil?
Sahil Goswami, head of crypto and Web3 at MVB Bank. MVB Bank is also a fintech enabling bank focused on crypto, gambling, gaming, and other emerging asset classes.
Awesome. And in the past probably 2 years, I've been working a lot in the sponsor banking and banking as a service. And I got to say, MVB and Cross River are two of the leading folks. If you're not familiar with them, people you should be talking to. And after meeting Patrick, BlockFills for you institutional trading folks. Really just awesome stuff. So we're not going to jump into a lot of the generic topics. We got a good we'll call it 101 in the last panel. It was really great to set this up. We're going to go a little deeper into specific topics. But before we do, I imagine, nothing going on or anything, but if you guys, I imagine, are getting a lot of calls in, right? And maybe from the institutional side. So I'll start with you, Patrick. What are you talking about now? What is it? What are the conversations? What are the big questions that people are asking you to answer? And then Leo, Sahil, maybe what are people calling you about?
Yeah, definitely. So it's been a busy few weeks for us. Been a busy few days, especially. The kinds of calls we're fielding right now have a lot to do with the opacity of the lending market in the crypto right now. That's obviously centered around what we were seeing with Celsius, who is under some pressure, as we all know. But from a trading perspective, I think that what's really coming to light right now is the importance of proper due diligence and counterparty risk and how we're going to look at that going forward. So we are fielding a lot of calls about our obligations and who our counterparties are. And BlockFills is not a retail-focused firm. We only work with institutional trading outfits, and we're in great shape. But it's definitely been a busy couple of days, and I think that going forward, there's going to be a lot examined about how companies price in the cost of significantly more extensive DD processes. So that's probably something we'll talk a little bit about today.
For sure, yeah, we're definitely talking about the sort of the traditional finance or TradFi, if you're following along, or digital finance and how they're going to blend and where we can kind of help each other out. So, Leo, what kind of calls are you getting, and what are people asking you to explain?
Yeah, I guess not as much because we're not as focused around the lending portion. I guess just to add on to what Patrick mentioned, though, in addition to counterparty risk, it's also making sure that our partners are okay. So, let's say specifically whoever is helping us with the trade execution, like that market maker, making sure that everything's going fine there.
Sahil?
I'd say a lot of our calls are a blend, right? You have your TradFi calls, folks that are that have some exposure to the crypto market and want to understand the correlation between what's happening at the macro level and what's happening with crypto, and then our crypto clients that are really just trying to make sure that they have a little insight as to what some of their peers are doing as everyone kind of looks to each other. It's a very unique environment in that in prior bear markets or prior winners, you've had a crypto winner in isolation. This is arguably the first time we're seeing a macro-driven event that broader markets are in the middle of a downturn and crypto is suffering naturally because of that with some pretty intense correlation and then some. So it's interesting to kind of balance those calls, to discuss risk management, to discuss who our end clients are. Given that we're publicly traded, it's been a lot of conversations around how solid our balance sheet is.
Awesome. And so we really dive into use cases, right? Make it a little more specific. And so maybe I'm going to, Leo, start with you. What is Cross River doing when you think about crypto? What is your focus? And expand a little more what you're enabling and helping and who your customers are.
Yeah, our focus, so tagline that we have is bringing crypto to the next 1 billion people. And that really aligns with our business model of working with fintechs, so powering fintech companies. And so this is a B2B2C model that is basically an evolution of what we've already been doing around banking as a service. So working with some clients already, let's say like a firm on the marketplace lending side of things, or let's say Divvy in terms of card. So bringing fintechs the back end in terms of something like lending, banking, payments. For crypto specifically, one thing that we're focused on launching is helping fintech companies and users in terms of trading crypto. So bringing the right infrastructure stack for that through partners in terms of something like custody or trading to then help the end users of those fintechs access crypto. And just to wrap this up, one thing that we think is that a lot of the adoption will really come through retail users, through fintechs. So it's these consumer-facing apps that a lot of people will touch and then get access to crypto through that trading capability.
And Sahil, you more closely align with where Leo is as far as who you two work in the same field and with the same sponsorship level. What use cases are you enabling? How are you all thinking that MVB, what you're focused on? Right? Similarly, or what else?
I'd say it's similar. We have a lot of our existing client base that wants to expand into crypto, and we realized that, to Leo's point, that we have there's similar needs. You have custody, the ability to buy, sell, hold, the ability to eventually stake, lend, stablecoin settlement. So there's the crypto native use cases, there's the crypto enablement use case, there's the Web3 use case of you have some growing companies that need banking partners and want to figure out the role they're going to play in a broader ecosystem. And then you have your TradFi use cases. So thinking about issuing mortgages on-chain, thinking about issuing auto loans on-chain, and what that would mean in terms of disrupting title insurance, kind of negating the insanity of current mortgage origination. I was a former subprime mortgage trader, so I've looked under the hood and seen what it's like to look at old Lehman and Bear Stearns paper and understand that a lot of this could really be prevented or circumvented. And so a lot of our efforts with some of the less crypto native clients are to disrupt the TradFi use cases.
And we're definitely going to get later into what is Web3 versus what's decentralization and sort of start to pull those apart. But before we do that, Patrick, you have a little different lens you're talking about. Right. And we were having a conversation before this that was pretty interesting. I'd love if you talk about your background and how informed what you all were doing and the choices you made thinking about the connections. And I think it's interesting for this group to hear who come from the traditional finance world mostly.
Yeah, so thanks for that. Yeah, so BlockFills is, our leadership all comes from traditional trading and markets like FX, equities, and futures. And so we stepped into this space because the technology that existed around 2017 when the company was formed was very underwhelming. If you wanted to trade crypto, you had to do it on an app. The experience wasn't great. At an institutional level, there was just zero support. So We basically went to some of our capital partners, our market relationships we had from the traditional world, and basically said, look, put some crypto on your balance sheet if you don't have it already, and stream us a price. And we use technology that's prevalent in traditional markets. It's commonly known as fixed connectivity, which is a very, it's designed for active trading. And we basically stream that price out to end users, not retail customers, but rather organizations like Leo's and Sahil's. And they would take that price, mark it up, and then face their own clients. So what these gentlemen are talking about in terms of looking for partners that they can use to offer those solutions to fintech companies, we sort of sit behind there, and we can actually provide that trading liquidity to these groups who are building solutions that will access or will be offered to markets that we ourselves will never reach on our own. So we're looking at it much more from a trading perspective. We have branched out into a lot of other areas, and we have also realized that our technology services need to be a la carte, which is, I think, is a thing we're seeing in this space a lot as well, is you have an amalgamation of third-party pieces and technologies, because we can't walk in and stomp all over someone's existing technology. We usually will need to give them something that they can integrate with what they have already, and so we've had to become nimble. So we have this trading focus, we have this tech focus, but we definitely see things through a slightly different lens than the banking and credit union side.
And I want to maybe, for those who aren't as familiar with the trading side, I want you to dig in a little more to the and think about comparing how you decided to use the fixed connection versus what you've seen, I'll call it crypto companies do, without having your background and experience.
Yeah. So there are lots of different ways to distribute data and send order instructions. So in the traditional markets, you use fix, and a lot of crypto native firms, exchanges, use something called WebSocket or REST connectivity. And so there was a business decision made very early on at BlockFills that we were going to be fix dominated, because all the HFTs and the traditional firms who are migrating from these legacy markets are going to demand the kind of responsiveness and speed associated with fix. But a lot of the retail exchanges now in crypto are WebSocket and REST users. And so it's just, you can very quickly, when you're dealing with these groups and trying to figure out a trading relationship, you can very quickly see who has experience in the traditional world based on the type of connectivity they have chosen to use. So we believe that as more and more traditional firms move into the space, that they're going to demand the kind of responsiveness and connectivity associated with fix. And of course, we can be nimble, and we want to go where the clients go, and we can give them adapters and things like that to deal with WebSocket connections. But we really are advocates for better technology when it comes to actually executing orders.
Yeah, and I think let's sort of use this to roll into the traditional finance versus decentralized finance. We'll hybrid a little bit. So maybe Sahil, we'll start with you. When we're looking at the differences, so you probably get some Web3, or we'll call it decentralized DeFi, Web3 companies coming to you. What is it that maybe they don't understand around the traditional finance side, or vice versa? How do you delineate the two, and where do they maybe have a disconnection?
So a conversation that I had earlier today was around what the reaction is of some companies when you ask for their KYC and AML policies. And I think that's honestly one of the biggest ways to differentiate between a crypto native company and one that's not, is that the crypto native companies are surprised at the need for basic banking protocol or risk management level data. And it becomes a conversation where, well, that's really what you need to kind of come on board as a client. And I think that's been the big difference between some of these crypto native firms and more TradFi focused or TradFi staffed firms, is there's an understanding that there are some rules with which you have to abide to kind of enter the broader ecosystem. And the tech only players are very focused on the move fast and break things mentality, which works to a certain extent, but as you get bigger and as you scale, you're really unable to continue without really putting the right protocols in place. So to that end, we end up having conversations or referring folks over to a compliance platform that can really help them get up to speed, get the right licenses, get the right KYC and AML policies in place, and not to knock the missions of these companies. It's a learning curve that we're helping facilitate. We'd love to take them on as clients, but we've seen that move away, the mental move away from banking, as banks are the enemy. So we're not going to really do what banks need, but eventually you have to.
Yeah, so I'll add on to that as well. And then I'll talk about securities law. So basically, let's say with DeFi, for example, like just because something is possible technologically doesn't mean that that's possible from a regulatory perspective. So, let's say even some specific examples around yield. Right now with interest rates, they are rising, but let's say when you compare DeFi with traditional finance, DeFi has much higher yield. The question is like, who can actually access that yield? So let's say, for example, like with BlockFi and that settlement that happened with the SEC, like what they were doing was deemed to be a security. So that's just not available through to retail customers. So definitely, that brings implications in terms of, let's say, what tokens can be supported, which tokens are deemed securities and not. And then also, from our perspective around, let's say, high yield savings accounts, one thing that would be interesting is, let's say, what type of framework can a bank bring in to then offer yield through something like DeFi? So that's something that we are looking into.
And Patrick, I'd be curious, so on the sort of the trading side, what is, is it more similar because, or not? Is there different perceived or actual risk between either if you're coming from the traditional trading side going into it or vice versa? It seems to have a lot of the same kind of characteristics. You're trading for FX or trading stocks, trading commodities, what's crypto, right? Same idea. But how do you view that perceived versus actual risk?
Yeah, from a trading perspective, if you're a very active trader, you really care about volatility. So if the market is moving, generally speaking, that's a good market to be trading. A market is flat, with very little volatility, it's generally considered to be less attractive. Now, in the case of what's happening with the crypto space right now, we're all here because we want this thing to work, right? I mean, we appreciate the volatility. Do I want this to continue for, the next 3 to 4 years? Probably. I'd prefer it doesn't. But our typical trading clients, they're an experienced bunch, and they're trading in relatively sophisticated ways with us using spreads and options and things like that. We can handle all of that business, but we have to change our perception of, or how we talk about risk when we're dealing with institutions who are looking to find a relatively reasonably safe way to introduce digital assets to their clients. So this audience is I would communicate very differently in terms of what our offerings would be like, and it would be much more about the technology and the liquidity and less about the creativeness of the trading that we're doing. So I guess the short answer is that it does look a lot like our regular the trading we would have engaged in prior markets with maybe a touch higher volatility, to put it lightly. But in the case of how we serve the community, especially this community, it's going to be more about the technology and the liquidity and less about the trading itself.
And then this is to any of you. Is there anything specific where you think there's still a pretty big gap in either the traditional finance versus, we'll call it the Web3 DeFi side, they're still not on the same page yet? Is there anything that stands out that you guys would bring up?
I'd argue that there was this misconception that crypto can live in a silo and escape the gravity of broader markets. And I think the past week has shattered that, to say the least. And I think a lot of folks are learning the concept of what good risk management looks like, what it means to fear going concern, and what it means to think about broader counterparty risk and broader exposure. I think exposure contagion is not something the crypto space was really all that worried about in the last crypto winter. And I imagine that the word contagion is going to get used in every other news article over the next 48 hours.
It already is. I thought this was supposed to be an anti-inflation asset.
Yeah.
What happened?
Steady, lads. Steady. So before we kind of move on to specific use cases, you brought up due diligence, counterparty risk earlier, and that's something where at Cloudcase we talk about this a lot. We can provide that business orchestration and all the decisioning, all the compliant sort of visibility into saying we did all of the traditional finance items before it goes onto a blockchain. But Leah, you brought that up, and I'm curious around, what do you think is needed to get this due diligence going? What is it that to mitigate risk or have better on-ramps that you would suggest either we be thinking about or that Cross River's thinking about?
Yeah, I think one thing actually is the importance of education, especially institutions educating the different teams within the organization. And there's a few points behind this. So one example is, let's say, info security, IT due diligence. It's just really important to make sure that the cybersecurity and all those different items are all just satisfactory, because these are new types, or potentially new types of risks that institutions have to deal with. And so filling that knowledge gap that maybe some of the teams that are experts in security but not as familiar with crypto, that's been really important. And then the same thing applies to, let's say, a team like credit risk, teams around compliance and all of that. So basically getting everyone internally speaking the same language, that's something that is still a work in progress, definitely, but will be really important in being able to push things through. So I think that's one point there.
Yeah, I just have something to add to that. You know, just thought of this as you were talking there, Leo. We at BlockFills, we do not automate settlements. We get asked all the time, why don't you have automated settlement platform? Meaning, why can't I have an API endpoint to pull assets? Well, because we have an institutional client base and we don't have hundreds of thousands or millions of clients, we have the time and the energy to do a lot of manual and human verification. So, and I can't say we will never have an automated, settlement solution, but currently, if somebody wants to settle, we have predefined secure communication methods to request settlement. And so sometimes we are asked, like, well, where's the API endpoint? Why can't you make this easier? At the end of the day, it's for security and for safety. And so that you often see that in the traditional world as well. And so our ops team and our risk management team, who all come from that background, are willing to sacrifice a potentially upset user for the security of the entire organization. So that's one way you're seeing the traditional finance sort of mantra come into this world. And frankly, we work with a lot of counterparties, trading counterparties, who do have automated settlement procedures, and they don't work half the time. We have to call them anyway and get verification, and we have to go through this, this long process to get assets out. So it's, that's something that eventually I think will probably be improved, but it's an example of how sometimes a more traditional way of operating can actually, protect the business and its clients.
Yeah, it has been kind of fascinating to see a lot of the DeFi world start quickly realizing where regulations or maybe just guardrails of some sort have been helpful, or how they're coming to the same conclusions, right? There's a lot of, never mind. So you were talking earlier about use cases, right? So I'd like to just pick one. I don't know if one sticks out. You said title insurance, you said mortgage, you said some of these things. And something the last panel I think really emphasized that's important is a lot of the products themselves aren't that different, right? It's still a mortgage, it's still a loan, it's still a payment, it's still a value movement, whatever it is. But the way that you can do it, simplify it, manage it, really changes when you have a underlying blockchain layer to, encapsulate a title in an NFT or something, right? So one of the things that I'd like this audience to think about is there's a lot of great knowledge in institutional product and financial engineering in the positive way that I think could be done and made easier with blockchain, right? So, which use case do you think you want to talk about?
Mortgage is my favorite. As a former mortgage guy my portfolio manager said that in order for me to learn the mortgage business, I was sent to a warehouse in Buffalo and went through 50 mortgage files, 1,000 pages each. Fully understood each person's income, how it was verified, their bank statements, verification of any gifts they received, the whole shebang of the mortgage origination process. And if I think about a lot of the data that has to be aggregated as folks come on board, and the connectivity that already exists in the Web 2 world, to be able to pull that data from your bank, from Venmo, from your employer, I imagine that there's so much more that can be done in terms of the secondary piece of why that's done in the first place, which is what happens to your mortgage after it's closed and sent to your bank, and how it's traded away. And so I think the piece of if Bank A decides to buy from Bank B, they're going to re-verify all of the data in your mortgage. They're going to spend a lot of money kind of making sure each piece is in that file before they buy it for regulatory reasons. And as they do that, they're paying. And that cost is, in turn, really passed on to the consumer. That's part of what you pay as you originate your mortgage. And then I think about the bonds that exist that bundle all those mortgages up, and the fact that every 30 days, the payment information of whether or not you paid your mortgage makes its way to the bondholder. All of those costs are inefficiencies. And all of those inefficiencies can be really squared away by having a live ledger that accounts for every mortgage, every payment that's made, and for everyone that's leveraging the product. And I'd argue that rates today would likely be lower if you had an on-chain mortgage system. And I imagine that Fannie, Freddie, the GSEs are going to move in that direction. It's easier, it's cost-effective, but it's going to take time and it's going to take buy-in. The title insurance piece, really quickly, just personally, it boggles my mind that you have to pay to make sure that you actually are getting a home that you will own. It's insane. I think there are a lot of legacies in the asset-backed lending space like that. Car titles, same thing. I think a lot of folks bought cars online during the pandemic, and a lot of folks ended up getting arrested because the title hadn't transferred from state to state. I mean, the way I see it, that shouldn't take 3 months. That shouldn't take 4 months. That should be instant. And being able to leverage on-chain tech solves for that.
2 fun facts. One, I'm waiting on a title because I couldn't find it for my car I'm trying to sell, and I said there, and this first thought of, how is this? Why can't I just point to an NFT that's got my title on it?
Yep,
That just
exactly.
makes absolutely no sense. And then my marketing team, and Kim, if I didn't say it, Cloudcase customer has the world's fastest mortgage. And it actually builds off of the conversation before. It's out of Australia. It's 40 minutes. But a big reason that it can't be 40 minutes is access to data that the Australian market has a lot more there. So we can look around the world at different jurisdictions that have maybe real-time payments more ubiquitous and see what's possible, but then made even simpler when you add a database layer that's like a blockchain that gives you even more programmability. That's the idea, right?
Fingers crossed.
Yeah. So Leo, Patrick, I don't know if there's any specific use case, and Patrick, we have a different lens, but that you think we would bring up.
Yeah, so two things I'll touch on. One is the idea of a use case for our business is sort of strange because we already are in this, like we're already doing this at a large scale. But one thing that we really want help with, or are trying to figure out how to do, is to communicate our offering to groups who understand how to communicate with banks and credit unions, and how can we package up what we already do in a way that is palatable. So that's a tough thing for a group like ours who's not in the banking business per se to do. So that's something that we are really working hard on. But the other part is the asset management as a service part of our business. So I live in Austin, and there's a meetup every month that I go to, and I talk to these brilliant developers and DeFi guys and whatnot. And I had this conversation with this gentleman. He's building this NFT collection or something, or something on the Ethereum blockchain, and he had a bunch of ETH. And he's really excited, and he's amped up about doing it. And then I see him 2 months later. I'm like, how's it going? He's like, well, I had to fire everybody because my treasury was in ETH, and I can't pay anybody because of what happened to the price. And so what we do at BlockFills, and something that we are expanding our scale of, is how we can help organizations that have crypto on their balance sheet manage the volatility of their balance sheet. So I live in Texas. I work with a lot of energy companies who are sort of getting into the space. We love the way they look at it because they look at it like crude oil, something that has to be produced, stored, hedged, has a forward curve. They don't have this sort of moon boy attitude. And if more people in the younger developers and the people who've built up these enormous treasuries would think a little bit more from the risk management perspective of how they can protect their company using a proper counterparty who understands these things, because it's we're no stranger to it. We think that that has really yet to permeate the space. Now there are some regulatory restrictions around derivatives and options, and it's not one size fits all. But that's an area that I think we are doing a pretty good job at. But we would love to let the world know a little bit better that possibility exists.
Yeah, Leo, anything come to mind?
I'll add on the payment side of things. And so this is basically payments, so a traditional banking product in helping crypto companies. And so the importance of this is that, let's say for an exchange, there has to be actual fiat that goes onto the exchange first before a consumer can then use that to purchase crypto. So let's say something like the fiat on-ramps and off-ramps, which is basically just moving money from one account to another via payment rails like ACH and wires. That's just something that's really important for whether it be an exchange, a fintech app, or other ones to bring money into the crypto ecosystem. And then something else that's more so going on in the market is actually around accepting crypto as payments. So just to cite one example, Chipotle announced, I think either a week or so ago, that they're going to accept crypto as payments. And then they're actually doing this through another company called Flexa, which is a financial infrastructure company. And what's interesting here is that Chipotle, I actually doubt they're actually holding the end Bitcoin that is being sent to Flexa. What's actually going on is that company is taking in that crypto and then converting that into actual fiat currency. So, maybe one day these companies will actually hold the crypto, but right now it's still a big move in terms of adoption by letting people be able to, by letting merchants accept crypto. And then even, let's say, for example, like Fireblocks and Checkout.com, what they're doing with USDC, which was touched upon in the previous panel, that's a pretty big step forward as well in Checkout.com powering a lot of e-commerce companies, and now people eventually being able to just pay via USDC as another payment method. So crypto becoming a payment method, and then these infrastructure companies enabling that on the back end.
Well, I think in the last sort of 8 minutes here, I'd like to either, if people have questions, that's great. Maybe one last bit here of if we kind of recap. We've got blockchain, which is a new database. To that, the one instance in the first use case was crypto, right? And then, as we've been alluding to, and as the last panel highlighted really well, there's lots of other ways to use the blockchain technology that have nothing to do with crypto, whether that's a public blockchain or a private blockchain. And there's lots of simplifications and back-end items that can be done. And then the other thing that we've highlighted so far is that there's a lot of great use cases, a lot of great lessons learned, risk management that's already coming from the traditional finance world. And we all, in preparing for this, and this has been the same conversation for almost the entire crypto, which is like 15 years, or whatever it is, 10 years of, it's going to be a hybrid that wins. It's going to be a hybrid that starts blending these, because we have to have on and off ramps between whatever the blockchain world is and whatever the fiat world is, and that's fine. So I would love, we were talking about education, we talked about how to get started. I don't know, giving this audience some advice, and now knowing that A, it's a lot like what you're doing today, by the way. B, there is some education to learning how it can change or rethink what you're doing today. How do we get this folks started who maybe are a little more open to it now? Of where would you suggest they go? And please don't say some YouTube follower. Or, but anyway, but there is a lot of good information on YouTube. But just in general, how do we get started? How do we get educated? Where do they go, other than talking to you three fine gentlemen? Or is that it? We'll just leave it here. But any place to start?
I could start with something. I think that one place you could begin to think about this is realize that you can take an approach to making digital assets available incrementally. So you don't have to offer your clients 30 currencies on day one. You don't have to even give them the ability to withdraw. If you don't want to deal with wallets and all the verification, all the stuff that comes with that, you could start by just giving them a bid offer on a chart or a screen that they can push a button, and that you can have a custody solution effectively behind the scenes that's taking care of it. And so most of the technologies that are out there are scalable, and ours included, and these gentlemen as well. And I think that that's probably a great place to begin, is you got to start somewhere. If you're going to get involved, it doesn't have to be the whole shebang right out of the gate. It's very possible to start with a much smaller offering, and then just build on it as you see your clients and customers' demand increase.
Yep.
I'd actually say the opposite end of the coin there is being mindful of what the roadmap is for the future and what the possibilities hold. So for example, let's say even with having a bank account and then what can be added on top of that, one part is with high yield. And with that yield, there are different options for that. One option might be, let's say, through staking. The other option might be working with different yield providers to be able to generate that higher interest, then pass on to the end user. But then it's also, let's say, like, even which partners to work together with on that. Do you want a company that is really good at like one thing, or another company that might be able to provide more of a one-stop shop in terms of a multitude of different offerings? So I think in conclusion, it's really a lot of being mindful of what's really possible in the future. Even though right now things aren't looking as hot with the market and everything, it's still not losing sight of what's to come.
Really quickly, I'd say that the incremental piece is really important, right? I think finding the right partners to build with is vital. I think folks that are flexible, forward-thinking, trying to future-proof their businesses and understand that change doesn't occur overnight. A vast majority of the bigger companies that get talked about in the news today were formed during the last crypto winter. And a lot of companies that are going to be making headlines and news in the next 3 years are going to get formed around now. And really partnering with the right talent, partnering with the right folks that understand that not everything can happen overnight, that there is a lift necessary, an educational piece necessary to get folks on board, is how we've been successful as a bank in terms of partnering with both crypto firms and making sure the FDIC is happy with what we're doing. So we answer to regulatory oversight, and that means really being transparent and clear, and a core part of that is the right partnerships.
Awesome. I'd love to open up to a question or two, and while if anyone wants to ask a question, I would say I'll add on to that saying separating crypto and blockchain is also a good idea, because you may find, as we're all trying to find efficiencies and simplifications in our management of assets, which now can be easily digitized, and all of the back-end processes to manage that, maybe that's where you find your use case, and you come to crypto later. But that's really, I think, a big starting point, and I know all the folks up here are more than willing to answer questions, educate people, and talk about their experience. So please do that before, if you want to catch them. But any questions from the audience that we want to talk about before we wrap up?
So Leo, a question for you. You were talking about DeFi yield, and I know one of the concerns around that is not knowing who the counterparties are on the other side, but it seems like there's been a couple solutions that have come out, one with Fireblocks whitelisting counterparties, and I think Chase this week came out with a similar solution. Now, I think both of those might have liquidity, do you have enough liquidity? But it's a neat solution for financial institutions that might not be comfortable getting into a space where you've got great yield, but you don't know who the counterparties are, because that could obviously be an issue from an AML, or you're dealing with a sanctioned individual. What's your thoughts on those solutions, and are we going to see more of those whitelisted solutions, or is there another option?
Yeah, that's a great question. And when you mentioned Fireblocks, like Aave Arc, let's say, that is one of those permission pools. I guess this is definitely something that we're looking into, but doesn't seem to be a full solution, because I think there's pros and cons. I think the potential con with something like a permission pool is your point around liquidity. So definitely important concern, and something that needs to be addressed.
And just to add to that, our clients on the lending side are not ready for smart contract risk on lending pools. They're just not there. Obviously, it's very popular, and there's plenty of money floating around those pools, and lots of really smart people getting involved. But we're finding at this point that the majority of our clients really want that kind of deal done over the counter. And that may change. And as we look at liquidity pools like that, we are only, at this point at least, looking at pools that all the participants are KYC'd.
And you make a really good point about the incremental aspect of how much you put on chain as well, right? You don't have to necessarily do a bunch of smart contract enabled items. You could just use it in very simple ways and keep that risk more on the traditional side and minimize what's on chain for that reason. And then there's all sorts of ways to choose which chain you're going to use and why and all that sort of stuff. But any other questions before we wrap up? Or any other last closing comments from you all that we didn't bring up you want to make before the last 30 seconds here?
Really quickly on that question, I think when you combine Fireblocks, other either SaaS-based custodians or sub-custodians, and you combine them together it's pretty easy to solve for the liquidity crunch if you have interconnectivity. I imagine that's the model we're moving towards, in which case you've solved for the biggest piece. You'll have a lot of permission pools available, and a lot of large institutions, I imagine, will start to jump in mass in the next 6 to 12 months.
Oh, you got to make it quick.
About 20% of their workforce, over I think close to 2,000 people. Just what's your comment on that? I mean, personally, to me, it looks like bad management. But just since we're talking,
That's some terrible optics, isn't it? Guy just bought a $150 million house or something. Yeah. Well, so I think that there is a lot of great talent we looked at maybe a year or two ago that we could not touch that is now going to be accessible to us. So I think there's going to be some great opportunities to bring some awesome people on board. But a lot of these companies went out big spends, very public, sports stadiums and F1 and all that. And it just kind of looks dumb. Yeah, I mean, just to put it plainly.
There are mortgage companies, tech companies. I mean, this is where you get to see that crypto is not all that different than a lot of VC-backed companies that have emerged over the past few years. It's just a different color.
And we're still figuring it out. That's a good way to put it, too, right? So with that, we need to close up here. Thank you so much for all of you coming, for talking about it. It's been awesome.
All right. Thanks, Patrick.